Hi friends, good morning all of you. So we are starting a new day with a new standard. So let us start with Ind AS 105, which is titled as Non-Current Assets Held for Sale and Discontinued Operations. What is the title of Ind AS 105? Ind AS 105 is Non-Current Assets Held for Sale and Discontinued Operations. So it consists obviously two parts. What are the two parts? One side, non-current assets held for sale. Second side, discontinued operations. Do we have any parallel standard for this in our old system, like regular accounting standards? Do we have any standard which is parallel to this? So, Ind AS 105. Put the heading in your notes. Ind AS 105. From this two arrow marks down. Left side, non-current assets held for sale. In brackets write down held for distribution to owners. So non-current assets held for sale and non-current assets held for distribution to owners. This is one part. Second part is discontinued operations. So for this we have AS 24. So in your CA intermediate syllabus you might have studied AS 24, discontinued operations. But here in international standard or Ind AS you call, the words used are, the word used is discontinued. Look at the title, discontinued, past tense. In accounting standard 24, if you remember the title, it is discontinuing, continuous tense, discontinuing. What is the difference between these two? According to AS 24, for applying this standard and disclosures, on the reporting day, the discontinuation process must be going on. So it is not over. That means, Pavan sir, I am sitting on 31st March 2021. In last year September, which essentially falls in this financial year. In this financial year, it falls. So in July, the company decided to discontinue some operations. In September, they sold the wing, they sold the division. So the whole process is over in July, August, September. So the next year, 31st March, that means the end of the financial year, is there any discontinuing operation? The answer is no. It was discontinued. That means the episode is over. But Ind AS 105 covers those discontinued operations also. That means I do not have any condition in Ind AS 105 that the division or the component should be discontinuing, even if it is discontinued anytime during the year also. Welcome to 105. I'll tell you what to do. Again, do you remember I told you before, there are some standards which are literally accounting, literally. For example, Ind AS 16. What is that? Property, plant and equipment. What you do is complete measurement. So you pass so many journal entries, you do valuations, okay, and then you write up the value, you write down the value, you do revaluations, depreciation. All these are passing journal entries. When you buy the asset, pass journal entries. When you dispose, pass the journal entry. Value increased, journal entry. Value decreased, journal entry. Isn't it? But there are some standards which are purely disclosure based standards. No much accounting will be there. So in this particular standard, Ind AS 105, in this standard, there are certain parts of accounting. Non-current assets held for sale, some accounting is there. And there are disclosure requirements also. And there are some other standards like Ind AS 24, related party transactions, pure disclosure. Segment reporting, we have already completed operating segments, you remember. That operating segments also pure disclosure, no accounting. And earnings per share, EPS. EPS also pure disclosure. You will calculate something and then you put it in financial statements, but you will not pass any journal entry. So there are certain accounting based accounting standards, there are certain disclosure based accounting standards, and there are hybrid standards like this where you will have some part of accounting and some disclosure also. All the accounting based accounting standards will have disclosure requirements also. That is a different story. So one part deals with the discontinued operations, which is something similar to your accounting standard 24. Majority of the content between Ind AS 105 and accounting standard 24 are same, but there are certain differences, like a subsidiary company acquired with an intention to resell. This is not covered by accounting standard 24. It is covered by Ind AS 105. So these kind of new topics are there, that also we have to see in this standard. Now coming back to part 1, as I told you, there are two parts. Discontinued operations is second part. What is the first part? Non-current asset held for sale. So what is a non-current asset? So a non-current asset, if you know, it can be property, plant and equipment, it can be intangible asset, it can be investment property. Investment property is also non-current asset only. So to recognize an asset in all these standards, to recognize an asset throughout all these standards, you call it PPE, you call it intangible asset, you call it investment property, there are certain conditions for recognition, conditions to satisfy, to categorize that into an asset, conditions for classification of asset. Conditions for classification. How can you classify it as non-current asset? How can you classify it as PPE? So in the definition part, in all these three standards, if you observe, it is clearly mentioned that the assets are held for use. That means not held for sale. Write down, not held for sale in the ordinary course of business. Not held for sale in the ordinary course of business. Okay. So Pavan sir, what is the meaning of this? Now listen. I bought an item. What is this item? A. I bought an item A. When I bought an item, I have invested money in the asset. I have invested money in this A. So when I have invested money, any person with common sense, when I have invested money, I want to recover my investment. I invested money, I want to recover my investment. How will I recover my investment? I recover my investment through future economic benefits. I recover my investment in the asset through future economic benefits. So these economic benefits are, you call it recovery of cost of the asset. Recovery of cost of the asset can be done in two ways. Economic benefits or recovery of cost of the asset can be done in two ways. By using the asset. By using the asset, you will have some economic benefits. Here, by selling the asset. If it is by using the asset, what will happen? you will use the asset for many years. So this is year 1, year 2, year 3, and so on, year n. So when you use the asset for more than 1 year, in different years you will get the economic benefits. Matching concept, you charge depreciation. To honor the matching concept, you charge depreciation throughout these years. Depreciation is recovery of capital, recovery of cost of asset. So cost of asset is recovered. Say 2 lakh rupees is the cost of the asset. 4 years is the useful life. You are charging depreciation every year 50,000. So what is year 1? 2 depreciation 50,000 in P&L. Year 2, 2 depreciation 50,000 in P&L. Year 3, 2 depreciation. Year 4, 2 depreciation. What is this? You invested 2 lakhs, no? That 2 lakhs you are recovering 50,000 every year. So the recovery of the cost happens through usage of the asset. But when the recovery is expected by selling the asset, this is the quality of a current asset. This is the quality of a current asset. This is the quality of a non-current asset. So simple. This is an item I purchased. This is an item I purchased. I am asking a question myself. Pavan, you invested 1,000 rupees on this item. Will you recover the 1,000 by using the asset, or will you recover the money by selling the asset? I said, I bought it at 1,000. I will sell it at 1,100. That is my intention. Then, my dear friend, this is your current asset, inventory. Inventory, if you remember by definition, are the items held for sale in the ordinary course of business. When I ask my question, Pavan, you invested 1,000 rupees, how will you recover this 1,000 rupees? In my mind, I said, its useful life is 4 years. I will use this asset for 4 years. Every year, I will get economic benefits by using this. So this depreciation, I will charge in 4 years. First year, 250 rupees. Second year, 250. Third year, 250. Fourth year, 250. I will put in P&L. That is how I recover my cost. Then, my dear friend, this is your non-current asset. Now the question is, an item which is originally non-current asset. An item which is originally non-current asset. Now you decided to sell it. Now you decided to sell it. So X Limited has a machine whose book value is 5 crores. The machine is 3 years old. And has a remaining useful life of say 2 years. I bought a machine 3 years back. I've been using it. Today in my books its value is 5 crores. It can be used for another 2 years also. This is the timeline of the asset. So this is timeline 0. This is timeline n. So here I bought the asset. Normally it is expected that I will use the asset up to this and then I will sell it at scrap value, realizable value. Normally I have expected that I will use the asset from day 1 till the end of the life, and then I will sell it at residual value. Residual value is also a selling price. So I will sell it at residual value. This was my mind. This was my intention. But today, somewhere here, I have decided to sell the asset, or to exchange the asset, or to distribute the asset to owner. So I am a subsidiary company. I have a holding company. I have announced a dividend. Holding company portion of dividend is say 4.5 crores. I need to pay 4.5 crores rupees of dividend to parent company. Parent company said, Pavan, you have that particular machine, no? You are not using that machine properly. Give that machine as dividend to me. So you have distributed this assets, non-current assets, to owners as a dividend. Pavan sir, is it allowed? Globally allowed. In India, dividends can be paid only in cash. Courtesy Companies Act 2013. In India, dividends can be paid only in cash. Dividends in kind is prohibited. But you look at US GAAP, you look at IFRS, distribution of non-current assets as dividends are allowed. Because we are following global standard, all this drama came. So distribution of non-current asset held for sale is allowed. In India, if your Companies Act is not allowing, you cannot do. But if Companies Act allows, this is the treatment. Accounting standard cannot override law, no. Accounting standard cannot override law. But for the limited purpose of Ind AS presentation and certain areas, Ind AS requirements can override Schedule 3 requirements. Normally, accounting standards cannot override law, but for Ind AS, there are some exceptions. Ind AS, some of the parts of Ind AS can override Schedule 3 requirements. That is a different story. Let us not go into that. Now, today I have decided to sell this asset. I have decided to exchange this asset. And I have decided to distribute this asset. So, Pavan sir, what is the problem in this? This day when I have decided to sell, say it is 30th November 2020. I have decided to sell this asset. On 30th November 2020, I have decided to sell this asset. So now this machine is held for sale. That means the cost of machine is expected to be recovered by selling the asset rather than by using the asset. Selling the asset rather than using the asset. Now, accounting standard 16 says, my dear machine, I am so sorry to inform you, you lost your privilege of mentioning yourself as a long-term asset. You are still an asset because I will sell you and I will get money. You are still an asset. But you lost your identity of sitting in non-current asset chair. Till yesterday, proudly you are sitting in this chair. Hey, who are you? Non-current asset, fixed asset, long-term asset. Till yesterday. Today, when I have decided to sell you, accounting standard will come to you, to the machine. Accounting standard comes and say, hey, machine, please get up. Machine asked, sir, why? Arey, please get up here. So machine stood up. Why, sir? Why you asked me to stand, sir? This chair is very nice, sir. Super cushion, sir. Semma comfort, sir. I'll sit here, sir. Accounting standard says, I'm so sorry to inform you, you are classified as held for sale. So technically, from non-current asset, you have become current asset. Because the definition of current asset is an item which is held for sale within this year. You call it within operating cycle, you call it the year. So now this machine has become current asset. So this is technically, what is this? Technically, this machine is no more non-current asset and is current asset now. So technically, this machine is no more non-current asset and it is current asset now. The moment you said current asset, two things will come onto the picture. The moment you said it is current asset, two things will come onto the picture. One valuation rule changes. Till yesterday, what was the valuation rule? Till yesterday, cost minus accumulated depreciation minus accumulated impairment loss is equal to my carrying amount. Till yesterday, who am I? Non-current asset. What is the valuation rule for me? Whether it is cost model or revaluation model, you take cost or revaluation minus subsequent depreciation minus subsequent impairment loss is my carrying amount of the asset. But today, my dear friend, you have become inventory. So the valuation of inventory is cost or NRV, cost or NRV, whichever is lower. So here also we follow the same principle, cost or NRV, whichever is lower. Cost or fair value less cost to sell, whichever is lower. So cost or NRV, whichever is lower. Here we are saying cost or fair value less cost to sell. Pavan sir, what is the difference between these two? Why in the standard they used fair value less cost to sell? They could have used the word net realizable value. The difference between these two is net realizable value means I have, one computer device. I have this asset. What is the selling price I get if I sell this item? If I sell this item, how much I will get is net realizable value. My negotiation skills are poor. I am not a good presenter. I am not a good marketer. One person came to purchase this. I said, sir, 1 lakh rupees, sir. He said, no, I'll give 80,000. I lost, in the deal. He is able to buy it for 80,000. He is able to buy it for 80,000. You are a smart guy. Same asset purchased on the same day, having same value. Same asset you have in your hand. You in the negotiation were able to sell it at 92,000. You are able to sell it at 92,000. Same asset. My NRV is 80,000. Your NRV is 92,000. Someone else NRV could be 96,000. So NRV is person or entity specific. Same asset NRV might change between X Limited and Y Limited. This asset is there in X Limited, its NRV can be 80,000. Same asset is there in the hands of Y Limited, it can be 92,000. I can sell it at a higher price or I can sell it at a lower price. So NRV is entity specific. Fair value is market specific. So if you have this asset in your hand, if I have this asset in my hand, you have asset in your hand, I have same asset in my hand. Fair value less cost to sell. Fair value less cost to sell cannot be different between X Limited and Y Limited. If it is 82,250 rupees to me, it will be 82,250 rupees to you. Because NRV is the actual amount the company is thinking of selling it at. This fair value is there, no? In Ind AS 113, you will come to know more about fair value. But in one sentence, if I have to put fair value, it is like, in a perfect market condition between two non-related parties, knowledgeable people. One is not forcing the other. No one is at the pressure. In healthy environment, in normal conditions, if there is no relationship, at what price this asset is bought and sold in the market? At what price this asset is bought and sold in the market? So how to identify that? Simple. You have opened Amazon. Imagine Amazon is dealing with this second-hand assets also. You can sell this asset, you can exchange this asset. Amazon asked you, Pavan, what is the machine model? I said machine model is so and so. Which year it is bought? I said it is so and so. So they asked a questionnaire. You give the details at the end when I said submit. They said 85,000 rupees is the exchange value, and we will collect 2,750 rupees towards collection of your assets, carrying expenses. We charge 2,750 rupees to come to your house to take the asset and to take it to our place. 2,750 is kind of delivery charges, pickup charges. I'm picking up asset at your doorsteps, it is pickup charge. So whether you have the asset in Mumbai, whether you have the asset in Delhi, whether I have the asset in Hyderabad, if the asset is same, you log into Amazon, give all the details, and when you click, you will get the value, no? That is irrespective of who you are. Amazon is not your relative. Irrespective of who you are, Amazon will quote the same amount. So it will not give different amounts. This is fair value. So fair value cannot change between two organizations. Net realizable value can change between two organizations. That is the reason in this particular standard. In many standards, they used the word fair value less cost to sell. In India, this fair value model of accounting is relatively new. Fair value accounting is relatively new. It's actually very new. So management, accountants, though also auditors, chartered accountants, all these people started feeling, "Arey yaar, ye fair value accounting kya hai?" Pavan sir, how simple my life is. I bought it at 1,000 rupees, Pavan sir. 4 years useful life, 250 rupees depreciation. First year 750, second year 500, third year 250, fourth year 0. This is the carrying amount. So take 1,000 minus 250, 750, minus 250, 500, minus 250, 250, minus 250, 0. How simple life is. How simple life is. If I introduce fair value accounting, you have two problems. One, you do not know how to calculate fair value because you have never done that till yesterday. You are a 40 years company. Throughout 40 years, you are following cost model. Today, if I ask you, follow revaluation model or take fair value. One is you do not know. Second one is the economy as a whole. If you see, we are not ready for valuation because we do not have a system of proper valuation. There are valuation experts scattered somewhere, but do you think the valuation science, or you call it art? Actually, valuation is an art, not science. It is science also, but it is more like an art. So do you think this valuation science and art matured in India enough to do fair valuation? You are doing fair valuation, but are you getting a fair price? Are you getting a correct fair valuation? If you are not doing it, management bias can be there. That could be error, that could be fraud, that could be misstatement in financial statement, that will hit your true and fair value. This is one more problem. Third problem is, what if management manipulates intentionally? That could be a bigger risk. So because of these reasons, we have not introduced fair value, but when this convergence agreement between normal accounting standards and IFRS, we converge with IFRS, we develop Ind AS. When this promise is made by ICA, we do not have any other option but for going to fair value accounting. So what is the valuation of, what is the valuation principle of inventory? Cost or NRV, whichever is lower. Because this non-current asset is categorized as current asset now technically, because this non-current asset is technically current asset now, it cannot be carried at cost minus accumulated depreciation. It should be valued at cost or fair value less cost to sell. So simple, like NRV, you will calculate fair value XXX minus expenses related to sell XXX. So your fair value less cost to sell is XXX. Your cost is YYY. So this or this, whichever is lower, will be put in your balance sheet now. This will be put in your balance sheet now. Pavan sir, shall I put it? So in my balance sheet, here machine, here machine, XXX rupees is there. Now it is XXX or YYY, whichever is lower, say this is lower. So here previously X is there, XX is there. Now I am saying beta, your valuation rules changed. So it is not XXX, it is YYY now. This is what accounting standard said. So the accountant of the company, he opened his books, he crossed this valuation, and in this place he has written YYY, and now asking IFRS, dear IFRS, are you happy? IFRS says no. No. Then accountant asked, now what is the problem? I did what you told only, no. IFRS says, shameless guy, that is in non-current asset category. Oh my god. Remove the whole drama from here. Non-current assets are there, no? So here non-current assets are there. Here current assets are there. In current assets 1, 2, 3, 4 items are there. This particular machine shall be presented not under non-current assets. Come down, come down, come down, come down, come down. Pavan sir, can I put it in current assets? Wait, come down. All the current assets are there, no? Like cash, debtors, trade receivables, all these things you have written, no inventory. After the current assets, write it here. Machine. Why? So you changed the valuation, you changed the presentation. Measurement changed, presentation changed. You understand? So when you convert non-current asset into current asset, this will happen. When you convert non-current asset into a current asset, this will happen. Point number 1. Point number 2. Pavan sir, you said 2 major changes are there. First change is valuation. What is second change? Can you guess what is the second change? Can you guess what is the second change? No depreciation from now on. No depreciation from now on. You are no more a fixed asset. No, you are no more a non-current asset. No depreciation. Why? Depreciation can be charged only if your intention is to recover the cost of the asset by using it. When you use it, there is depreciation. When you retire the asset from active use and then you put a sticker on it for sale, it has become inventory. Simple. You have a car. You have been using this car in your business. You have been using your car in your business. So it is property, plant and equipment now. So there is a shop, your shop. In front of your shop, in the car parking place, daily this car is there. So this car is proudly looking at all the neighbors, this side, that side daily. Then you asked one fine day, hey car, itna ghamand kyun hai be? Why are you so proud? Car said, I am BMW. Non-current asset. The owner came out of the shop, has put one board on this BMW. What is the board? For sale. Now this BMW from this non-current asset, it will be. Because beta you are about to be sold. Then no more depreciation for you. No more cost minus depreciation valuation for you. No more Maharaja chair at the top of the balance sheet. You will come to the bottom of the balance sheet. You understand? So the whole drama, whatever I told, do you understand it? The understanding of the standard is very poor. Okay, conceptual understanding of the standard is very poor. So people do not know. Even at a chartered accountant level, when you are preparing financial statements also, because you have not studied this when you were a student. When you were a student, you studied the different set of accounting standards where non-current asset held for sale is never discussed in your accounting standards. Have you read in accounting standard 10 non-current asset held for sale? Have you read it in your intangible asset? Have you read it in investment property? No. So this is relatively a new concept. That is the reason I thought, let me explain the whole story to you so that you understand the standard and it develops the interest. Otherwise what happens? I will give you, some rules and proformas and all that will become mechanical. So I strongly believe at final level, learning should be conceptual. Learning cannot be mechanical. You cannot mug up, okay? At final level, you cannot mug up. So this is what Ind AS 105 is all about. Then after the whole drama, we will go to the other part. What is the other part? Discontinued operations. That also we have to discuss. Okay, so you understand the introduction. Can we go inside the standard? Now tell me, what is the current asset? What is a non-current asset? Previously we used to call current asset fixed asset. Now we are calling current asset non-current asset. So understanding non-current asset is simple. Non-current asset is an asset which is not a current asset. So this item cannot be classified as current asset. This item cannot be classified as current asset. So it is classified as non-current asset. So for non-current asset there is no criteria. Current asset criteria is given. If you satisfy the criteria, it is current asset. If criteria is not satisfied, then this cannot be classified as current asset. Then it will go to non-current asset bucket. So non-current asset is an asset which is not a current asset. Now what is current asset? Some overaction students will take, over smart students. Our current asset is an asset which is not a non-current asset, sir. Seriously, ICA will kiss you with left shoe. Don't manufacture definitions, okay? What is a current asset? Now, look here. I trade in pens. So I buy and sell pens. I bought 1 lakh pens at 6 rupees cost. Expected to be sold at 9 rupees. How many pens I bought? 1 lakh pens. What is the buying price? 6 rupees. What is the expected selling price? 9 rupees. But my inventory holding period is 14 months. So before selling this 1 lakh pens, I have to store them for 14 months. So pens 1 lakh into 6 is equal to 6 lakhs. This is the item. Should I put it in current asset? Should I put it in non-current asset? You tell me. I am waiting for your answer. So on the date of balance sheet, is it a current asset or non-current asset? Tell me the answer. Current asset. Why current asset? But its life is 14 months in my hand, no? So isn't it non-current asset? The answer is, all of you are right. This is a current asset. How many months you have that in your hand is irrelevant. Your intention is to resell, no? So you bought this for selling. You bought the item for selling. No, Manesh, Shreyas, it is not dependent on the operating cycle, okay? Operating cycle is another condition. If you buy an item with an intention to sell it in the normal course of business like a trading activity, that is always a current asset. So if inventory is held for 14 months, you cannot put inventory in non-current asset. Inventory is always a current asset. If you are buying this finished good for trading, that is always a current asset. You understand? You understand? Now, X Limited sold goods to Y Limited worth 1 crore. Credit period given is 2 years. Credit period given is 2 years. So, on balance sheet date, Y Limited is showing a debit balance of 2 lakhs, 1 crore. Shall I put it in current asset or non-current asset? You tell me, shall I put it in current asset or non-current asset? Hello, answer please. Okay, I got the answer. Current asset, current asset. How come everybody is saying current asset? Seriously? Guys, come on, this is a non-current asset, okay? An asset which is expected to be realized beyond a period is non-current asset. No, Gaurav, what you are saying is 5 years, 6 years back, what used to happen in India, it is expected to be realized within 12 months from the end of the reporting period. No, it is not. Current asset definition changed, my dear friend. Current asset definition changed. It is not 12 months now, it is operating cycle. It is operating cycle. So first you calculate your operating cycle. Imagine your operating cycle is 9 months. Your operating cycle is 9 months. Credit period given is 2 years. Your operating cycle is 9 months. Credit period given is 2 years. So this is not a current asset. Because this is not a current asset, it should be treated as non-current asset. That's all. Simple. Now, Pavan sir, in some industries, operating cycle, inventory turnover ratio has no meaning and purpose. When you calculate operating cycle, it sounds ridiculous. It sounds ridiculous. For example, bank. Can you calculate raw material holding period plus work in progress holding period plus finished goods holding period plus debtors collection period minus creditors payment period is equal to operating cycle? Can you apply this to ICICI Bank? Don't you think you are mad? What is raw material holding period, work in progress holding period for a bank? Can you apply this to a construction company? Can you apply this to a financial services company? Can you apply this to a software company? Maybe no. For those enterprises where operating cycle won't give any meaning, they can continue 12 months measurement. You understand? So normally it is the operating cycle which decides whether an item is current or non-current. If operating cycle is not meaningful, then the entity follows 12 months. Cash in hand, cash at bank are always treated as current assets unless there is a restriction on the usage. For example, I have 5 lakh rupees in bank account. That is current asset for me. But I have given this 5 lakh rupees as a guarantee to some electricity department or to some government department, and there is a lock-in period on this fixed deposit that Pavan cannot withdraw this for 5 years. Pavan cannot withdraw this money for 5 years. So that is cash in bank, but has a restriction to use. And the restriction is more than 12 months. If the restriction is 3 months, still it is current asset only. The restriction is for 5 years. Pavan, you cannot touch this fixed deposit up to 5 years. After that only you can. Usually what happens, if you know the business of chit funds, chitty business will be there, no? So you auctioned and you got the chit money, but you are unable to give any guarantee. Then what happens? It is a 50-month chit. In 20th month you auctioned and you lifted that. Now the chit fund company has to give money to you, but there is no guarantee. You are not a known person. Now what happens? When the chit fund company, some chit fund companies will take lot, like lottery. They'll write all the names of people, they'll put it in a bowl, and then they take it. So your name came. So you have to take the money now. But if this money is given to you, 20th installment you are getting money, you need to pay remaining 30 months, no? Remaining 30 months EMI, who will pay? You have to pay. What if I give the whole money in 20th month to you? If you are not giving guarantee to me, you will take that money and run away. What will happen to my business? What will happen to remaining subscribers? So I insist, either you give guarantees, like a government employee, if it is guaranteed, then I'll give the whole money. If you are not paying, I'll catch the collar of that government employee. But if you cannot give guarantee, then they will put that money in fixed deposit in the same company. In the same chit fund company, you can put it in fixed deposit. So you have lifted 1 crore rupees on 20th month, but they will not give up to remaining 30 months. Or what they do, they'll calculate what is the remaining liability. That remaining liability amount they'll put in FD with the restriction that it cannot be withdrawn till the end. The remaining balance, if it is there, you will take that cash. So now I have a fixed deposit, but that fixed deposit cannot be withdrawn for 30 months. Pavan sir, can I include that in current asset cash with the bank? Imagine, even if it is not a fixed deposit also, it is in my current account or it is in my savings account only. It is in my bank savings account or current account, but there is a restriction on it. Then it cannot be treated as current asset. This is what the meaning of current assets is. An asset which is not a current asset is non-current asset. So let us go and read this definition. Too much of knowledge today. Okay, just look here. Ind AS 105. Can you read the diagram? The first one is accounting for non-current assets held for sale or disposal group. What is disposal group? After 5 minutes we'll discuss. Discontinued operations. So what about non-current assets held for sale? Measurement at lower of carrying amount, that is cost, today's cost, or fair value less cost to sell. Fair value less cost to sell. Measurement is whichever is lower. Then stop depreciation, cessation of depreciation. Then they are presented separately in the balance sheet. We have discussed all these things. Then discontinued operations, results of discontinued operations. That means from this discontinued operation, what is the profit and loss, what is the sale revenue, what is the expenses. All these things have to be separately given in P&L and disclosure. So we'll go to the scope. See, obviously there are exclusions. If you are dealt with by another accounting standard, don't come to me. That is there in every standard, okay? So Ind AS 105 do not apply for deferred taxes, assets arising from employee benefits, financial instruments, non-current assets which fall in Ind AS 41, and certain contracts which fall in Ind AS 104 for insurance companies. So this is scope out. This is scope out. Now, relevant definitions. This is what we are discussing. Current asset. An entity classifies an asset as current asset when 1. It expects to realize the asset, intends to sell the asset, intends to consume the asset in its normal operating cycle. What is this? What is this? Your intention is to sell it within operating cycle. Your intention is to consume it, raw material, within operating cycle. 2. It holds the asset primarily for trading purpose. Here, no criteria of operating cycle 12 months and all. If your intention is, I am a trader. Pen example I told you, I bought pens to sell pens. If I cannot sell the pens for 1 year, 2 year, 3 years also, still it is inventory only, still it is current asset only. I am unable to sell. See, take a medical shop. In medical shop, so many medicines are there. Now imagine they imported one specific medicine with a 10 years life. They want to sell it. Its value is 5 lakh rupees. They bought it. On the balance sheet date, they are unable to sell. Next balance sheet date also they are unable to sell. Then the management decided next 2 years also will not be able to sell. So will you put this medicine in non-current asset? No. If it is held for trading purpose, my dear friend, it is a current asset. 3. Expects to realize the asset within 12 months after the reporting period. First check with operating cycle, then come to 12 months. Then the asset is cash or cash equivalent. Cash flow statement. Accounting standard 3. In our language, Ind AS 7. Cash or cash equivalent unless it has restriction. It cannot be paid, it cannot be exchanged, it cannot be used, it cannot be used to settle the liability. That means basically you cannot withdraw it. You cannot transfer it. You cannot pay it to anyone. So there is cash or cash equivalent which is freezed, having a restriction for more than 12 months. This is current asset. Now read what is non-current asset. Simple. A non-current asset, single line. A non-current asset is an asset that do not meet the definition of current asset. Understand? That's all. So shall we take a break here and come back? Shall we take a break here and come back?